Welcome to RANsquawk's morning briefing for Wednesday the 5th of August 2009. Just going through 8:30 now in London, so quick check around the markets. Firstly, starting off with a review of the overnight press in China. China will stick to its loose fiscal policy for at least 3 years despite growing a budget deficit, as according to a government economist in the People's Daily newspaper. And elsewhere in the FT, they report that China's growth figures do not add up. The latest set of first half numbers provided by provincial level authorities are far higher than the government's national figure, raising fresh questions about the accuracy of statistics in the world's most populous country. Elsewhere, out of the US, a couple of pieces worth noting from the Wall Street Journal this morning related to fixed income. Ahead of the announcements we'll see of 3, 10 and 30-year note refundings this afternoon in America. Journal reporting that Treasury's debt plan more sounds of tips. The Treasury Department is seeking new ways to help fund its budget deficit. Is like to announce today a plan to ramp up sales of its inflation-protected bonds, according to people familiar with the matter. Apparently, according to the article, that's coming or chiefly stemming from demand that's being called for out of China. And elsewhere from the Journal, economists upgrade second half GDP forecast, predicting a brighter second half as Cash for Clunkers program boosts spending and US manufacturers ramp up their production. The article says we've seen the largest wave of upward revisions of GDP forecasts since the financial crisis began. Elsewhere, in terms of UK news, with quite a few data points, all mildly positive this morning, starting off with the nationwide consumer confidence report for July came in month on month at 60, above the expected 59. Halifax house prices in July came in month on month at 1.1% against the expected 0.6. That's the third month of positive gains there in the Halifax index. And also UK shop price inflation rose year on year at 0.5% against the previous 0.7%. So annual rate of British shop price inflation easing somewhat in July, helped by the weakest rise in food prices since December 2007, according to the British Retail Consortium. Elsewhere as well, much of the focus now to tomorrow's session, where we'll get obviously the ECB and also the Bank of England interest rate decision. More press articles in regards to the BOE's QE programme. The Times writing that pressure is mounting on the Bank of England after yesterday. They're looking now to expand radical scheme to jumpstart growth by printing further money after the bank's own figures revealed that a continued lending drought is blighting businesses and jeopardising recovery prospects. Banks' outstanding lending to businesses outside the financial industries plunged by a record 14.7 billion sterling in the second quarter from the previous 3 months, emphasising the danger that constricted credit could stifle any economic upturn. Looking elsewhere in equities, the main event of this morning was the Lloyds Banking Group earnings. Their first half pro forma loss came in at 4 billion sterling, slightly better than analysts were looking. They were looking for a loss of 5 billion. In terms of their impairment charges, extremely high, but nothing too much of a surprise for the market. That stood at 13.4 billion. It was the comments that have been relatively upbeat out of Lloyds. They say that they're well positioned to outperform in the midterm. They see second half impairments significantly lower than the first half, and they see results improving in the second half of this year and into next year. Their shares at the moment, half an hour into FTSE trade, up around 6% or so. Looking ahead then towards today, in the next half an hour, we're going to be eyeing the PMI service numbers out of Europe. We'll see whether they can follow the positive sentiment that we're seeing in the manufacturing PMIs earlier in the week. And then we'll look for UK industrial manufacturing production at 9:30. Quite a few US data points today. We'll be looking at the NBA mortgage apps at midday. Then ahead of non-farms on Friday, we'll have the ADP employment change and challenger job cuts this afternoon, alongside ISM non-manufacturing composite and factory orders due at 3 o'clock. For the energy traders, we'll get the oil inventory levels. We did see somewhat of a surprise drawdown in the API numbers after market yesterday, which did see WTI crude futures in the Asian session touch near $72. So we'll be keeping a close eye on the DOE numbers. And then elsewhere, as mentioned, we'll have the 3, 10, 30-year note refunding announcement from the US at 4 o'clock, allied to a Treasury coupon purchase of DEC 2013 to April 2016 durations.